number one son.
Market manipulation falls under the United States Code. According to the U.S. Senate, the United States Code is a compilation of most public laws currently in force, organized by subject matter. When a law has been amended by another law, the U.S. Code reflects this change. The U.S. Code collates the original law with subsequent amendments, and it deletes language that has later been repealed or superseded. The U.S. Code is organized by subject area into 54 titles. Titles are further broken down by chapter and section. Citations to the U.S. Code look like this: 42 U.S.C. 3282 or 42 S. 1382. This means the law appears in Title 42, Section 1382 of the Code. Here is a quick example. Cornell Law School provides a detailed example of market manipulation within the U.S. Code. Under the heading 15 U.S. Code, Section 78I, Manipulation of Security Prices, and Section A, Transactions Relating to Purchase or Sale of Security, in subsection 2, to effect alone or with one or more other persons a series of transactions in any security registered on a national securities exchange, any security not so registered, or in connection with any security-based swap or security-based swap agreement with respect to such security, creating an actual or apparent active trading in such security, or raising or depressing the price of such security for the purpose of inducing the purchase or sale of such security by others. 3. If a dealer, broker, security-based swap dealer, major security-based swap participant, or other person selling or offering for sale or purchasing or offering to purchase the security, a security-based swap or a security-based swap agreement with the respect to such security to induce the purchase or sale of any security registered on a national securities exchange, any security not so registered, any security-based swap, or any security-based swap agreement with respect to such security by the circulation or dissemination in the ordinary course of business of information to the effect that the price of any such security will or is likely to rise or fall because of market operations of any one or more persons conducted for the purpose of raising or depressing the price of such security. 4. If a dealer, broker, security-based swap dealer, major security-based swap participant, or other person selling or offering for sale or purchasing or offering to purchase the security, a security-based swap or security-based swap agreement with respect to such security to make regarding any security registered on a national securities exchange, any security not so registered, any security-based swap, or any security-based swap agreement with respect to such security for the purpose of inducing the purchase or sale of such security-based swap, or such security-based swap agreement, any statement which was at the time and in the light of the circumstances under which it was made false or misleading with respect to any material fact, and which that person knew and had reasonable ground to believe was so false or misleading. Investor.gov, run by the impotent, indolent, ineffective SEC, calls market manipulation. Market manipulation is when someone artificially affects the supply or demand for a security. For example, causing stock prices to rise or fall dramatically. Market manipulation may involve techniques including spreading false or misleading information about a company, engaging in a series of transactions to make a security appear more actively traded, and rigging quotes, prices, or trades to make it look like there is more or less demand for a security than is the case. Ironically, the SEC has sections on volatility risk and investment risk, all while doing almost nothing to regulate the securities marketplace.